losses. So here's what you came for. Coming in at number 5, Ally Financial, down 50%. It's no surprise, ever since I started my channel about 6 years ago, I have been a huge proponent for their savings account. I think their free services are fantastic, and they're one of the largest providers of automotive loans in the United States. But they're also one of the largest automotive lenders in the United States. And when the car industry is in shambles, their stock has taken quite the hit. Now thankfully, this stock only encompassed 1/5 of 1% of my entire stock portfolio, so it's not a huge deal to be down 50%. But still, it stings, and in hindsight, it was probably never worth $50 a share to begin with. After that, though, we got number 4, Fisker, down 53%. This was a company that was originally founded in 2007, and they came out with the Fisker Karma that was meant to be a direct competitor against Tesla. However, unfortunately, the car was plagued with issues and would sometimes just burst into flames. So the company was eventually shut down, and then in 2012, they were repurchased and rebranded as Fisker Automotive, and then they began selling cars again. For me, I saw this one as a highly speculative investment that could either do really well or crash completely, and you know where this one is going. Now, I think it's important to mention for context that I invested less than 0.5% of my entire portfolio here, so it's not like I went to full YOLO, but losing money is never fun, and this is probably one of the ones I'll have to cut my losses on for reasons I'll discuss shortly. Number 3, though, we also got Facebook, also known as Meta, down 56%. This one saw a complete implosion throughout the year, and I had no idea just how bad things would get until they just kept getting worse. But Mark Zuckerberg somehow managed to ruin a good thing, and now I'm down $50,000 on my investment. Again, my individual stocks are a relatively small part of my portfolio compared to everything else, but this one was frustrating. Now, number 2, we have Rocket Companies, also down 56%. Now, for those unaware, this company does everything from home loans, auto loans, insurance, solar. They bought ForSaleByOwner.com, and they also bought Truebill, which is now rebranded as Rocket Money. For a while, their business did incredibly well, but as interest rates increased, their business declined, and now they're trading under $10 a share. In hindsight, the writing was probably on the wall when the Fed started their quantitative tightening, but lesson learned, I should have taken profits way sooner. And finally, number 1, my worst performing stock of all time goes to Snapchat, down 82%. Listen, I have no excuses here. I gambled and I was an idiot. I invested $20,000 into Snapchat once they began falling from their peak, and I thought to myself, this is just an overreaction to a bad economic environment. Online ads are not going to go anywhere, and this is meant to be a long-term hold. But I was wrong. The company just had misstep after misstep, and now here we are again, back under $10 a share. Like I said, this was meant to be a gamble, and I paid the price, but at least we could turn lemons into lemonade, because I've got a Snap Discover show for anyone who wants to follow me there, and maybe Snapchat will eventually turn around. Anyway, now with the market having rebounded slightly from the recent bottom, it's making a lot more sense again to sell off a portion of my portfolio. And for all of you watching, there is a very, very good reason why. Although before we go into that, as most of you are probably aware, a lot of this recent downturn is fueled by the Federal Reserve rapidly increasing their interest rates. And while this could absolutely hamper growth, there is one benefit that's positively worth discussing. And that's all thanks to the sponsor of this portion of the video, Wealthfront. See, when the Federal Reserve increases their interest rates, the amount that you get paid through treasuries, bonds, and savings accounts go up. But not all institutions pass on the additional savings to the customer. Fortunately, though, Wealthfront does, and is currently offering one of the best APYs in the market at 3.8% within their cash account. That means if you deposit $10,000, you'd be on pace to earn $387 in the first year just in your savings for doing absolutely nothing. Even better, your money is FDIC insured up to $2 million through their partner banks. There are 0 account fees, unlimited fee-free transfers, and no minimum account size to get started. You'll also get access to a free debit card, over 19,000 free ATMs, and access to funds sooner with direct deposit. They also tend to increase their interest rates faster than the competition, with Wealthfront raising their interest rates just 2 days after the Federal Reserve's announcement on Wednesday, compared to other banks who could sometimes take up to a month. In addition to all of that, they also offer you free financial planning tools which could help you calculate whether or not you're saving enough for your future goals, like buying a house. So if you're interested, the link is down below in the description to get started today. And now with that said, let's get back to the video. Alright, so in terms of why now could be a good time to sell, it all comes down to a term called tax loss harvesting. Now, even though I've talked about this before, before, it's worth repeating because for those who aren't familiar with how this works, it could end up saving a lot of money, and it all begins here. Tax loss harvesting is a strategy that allows you to sell stocks that have lost money to offset the tax you would owe on the stocks that have made money. So here's a really simple example. Let's just say that I invested $10,000 into Ford stock that's now worth $15,000, and I invested $10,000 into Facebook stock that's now worth $5,000. Well, ordinarily, if I were to sell that Ford stock for a profit, I'd have to pay taxes on the $5,000 worth of gains that could be anywhere from 10 to 50% depending on the tax bracket. But according to the IRS, you could offset those taxes entirely by selling another stock for a loss. And if you do this correctly, you could wipe out all of the taxes you otherwise would have had to pay. This means that in a year where stocks are down, I would be in a really strong position to sell off the losing stocks at a loss to offset the taxes I would have owed on the stocks that have made money. In this case, there's very little downside because at the very least, I could increase my cost basis, and at the very most, I made a tax-free profit. This is also an incredibly common tax strategy that a lot of investors utilize at the end of every year. And if you have gains or losses that you don't mind trimming, then now could be a really good opportunity to do exactly that. Not to mention, if you have more losses than you do profits, then congratulations, you're able to deduct that off your ordinary income up to $3,000 a year, with the rest being deducted from future years. Of course, if all of this sounds incredible, well, it can be, but there are rules that you have to follow and things that you must avoid if you want to do this correctly. Rule number 1, you do not talk about Fight Club.
First rule of Fight Club is, you do not talk about Fight Club.
Okay, no, just kidding. The most well-known rule is what's called the wash sale. This is what happens when you sell a stock for a loss, use that loss to offset a tax, and then you go and immediately buy back in that exact same stock that you sold within a 30-day window. The IRS does not allow that because otherwise everyone would just continually sell off their losing stocks as soon as they could and then continually claim the exact same credit as often as possible. So that is a big no-no. However,